Okay, picture this for a second. If I offered you a choice right now, which business would you rather own? Think about it. Would you rather own a business that makes more money every single year or one that makes less?
I mean, it's a no-brainer, right? Almost everyone intuitively picks company A. It just makes sense. You obviously want the business that's growing. But the reason that choice is so incredibly easy really boils down to one extremely important word: revenue.
Welcome to The Explainer. Today, we're diving headfirst into what is absolutely the critical starting point for analyzing any successful company: revenue growth. It's the literal lifeblood of a business, and mastering how to track it is where top-tier analysis begins.
Here is our roadmap for today. First, we'll look at the front door money. Then, the power of consistency, the 4 drivers of growth, some major warning signs, and finally, the one big catch.
All right, let's kick things off with Section 1, the front door money, defining the lifeblood of a business.
So, what actually is it? At its core, revenue is just the total amount of money a company earns from selling its stuff, whether that's products or services, before any expenses are deducted. I like to think of it as the front door money. It's that raw intake of cash from whatever it is you sell, before a single bill ever goes out the back door. And this brings us to a really vital truth. You'll hear this a lot. Revenue is often called the lifeblood of a business. And honestly, it's spot on. Without that front door money continuously flowing in, a company is basically paralyzed. It can't grow profits, it can't hire top talent, and it definitely can't fund the next big innovation. Without revenue, the whole engine just stops dead in its tracks. Moving right along to Section 2, the power of consistency, and why looking at just 1 year of data is never enough. Track how Company A grows here. Year 1, they pull in $100 million. Awesome! Year 2, it hits $120 million. Even better. And by year 3, it climbs to $145 million. See that beautiful staircase pattern? That is exactly what professional investors are hunting for. It proves the business is actively expanding and building momentum, rather than just getting lucky for a single 12-month stretch. Now for Section 3, 4 drivers of growth. We're looking at the actual engine behind those numbers. Because let's be real, revenue doesn't just go up by magic, right? There are 4 main mechanics that drive it: new products, higher prices, more customers, and international expansion. To see how this actually works, we're going to use Apple as our real-world case study to see exactly how these levers are pulled. Let's look at that first driver: new products. Apple, like a lot of companies, started off relying pretty heavily on just 1 or 2 main things. But then they launched the iPhone, then the iPad, the Apple Watch, AirPods. You get the idea. The result? They created brand new multi-billion-dollar revenue streams almost out of thin air. Instead of banking on just one source of front door money, they built this massive ecosystem of products to keep the cash flowing. And this brilliantly illustrates our second driver: higher prices, or what the pros like to call pricing power. Imagine a company with a super strong brand sells 1 million items for $100 each. That's $100 million. But what if they hike the price by just $10? Because people love the brand so much, they just keep buying it. Boom, that is an extra $10 million in pure revenue, generated with 0 extra work and 0 extra products sold. It's wild, but that is the incredible power of pricing. Driver number 3 is beautifully straightforward. Just get more customers. If a local cafe goes from serving 200 customers a day to 300, their revenue shoots up, even if the price of their vanilla latte stays exactly the same. This is why businesses are constantly hustling to expand their customer base with marketing or better service. More people simply means more money coming through that front door. And the fourth and final growth driver? International expansion. I mean, why limit your business to just one country? The second a business starts expanding across, say, Europe, Asia, and South America, it instantly unlocks millions of new potential customers. It's this massive geographic multiplier and acts as a huge catalyst for the world's biggest and most successful companies. Okay, but what happens when things go wrong? Let's get into Section 4, warning signs. When the front door money actually shrinks. Now, what's really interesting about this is the contrast. Imagine Company B again. They pulled in $145 million in year 1. Great. But then it dropped to $130 million in year 2 and plunged down to just $110 million in year 3. This shrinking revenue, that is a glaring red flashing light for anyone paying attention. A multi-year decline like that is a major warning sign. It forces smart investors to ask some really tough diagnostic questions.
Are people simply bored of the product? Is a competitor out there doing it better and stealing those customers? Or has the company's innovation just entirely stopped? Look, a single bad year can happen to anyone, for sure. But if this downward trend lasts for several years, it almost always means the business has some deep, fundamental problems.
Which brings us to Section 5, the one big catch: why revenue is really just the beginning of the story. Because here is the absolute, unvarnished truth. Revenue alone does not guarantee success. Seriously, think about it like this. Doubled sales plus spending more than you earn equals still losing money. If your expenses are rushing out the back door faster than your revenue is coming in the front door, the business is failing. Period. Even if you have incredibly impressive sales numbers. And that is exactly why experienced investors view revenue as merely the starting point. To truly separate a temporary flash in the pan from a lasting, high-quality business, you have to combine revenue with metrics like profits, cash flow, and debt to get the full picture. Think of it this way. Revenue invites you to the party, but these other metrics tell you if you should actually stay.
All right, let's quickly lock in these core takeaways. 1. Revenue is the raw money coming in before expenses. 2. Multi-year consistency proves real, tangible expansion. 3. Growth is driven by new products, pricing power, more customers, and geography. And 4. Always ask why the numbers are growing to ensure that the trend can actually last.
Which brings us to our final thought today. Even if sales are growing year after year and the front door is literally flooded with cash, is the company actually keeping any of that money? That is the ultimate question about the danger of expenses, and it's exactly what we're going to uncover in our next explainer when we dive deep into profit margins. So keep asking those questions, keep looking at the data, and I'll catch you next time.